All right, hello everybody. My name's Mark. I'm the stock market jobber. I'm a former institutional trader who was the head of trading at three different money managers, where I oversaw the trading of various different hedge fund strategies and money management strategies and mutual fund strategies, risk management. I also traded directly for two of the best in the industry, Gabelli and Steve Cohen. I was traded directly for each of them, and I was also a market maker. So now my mission in life is to teach people like yourself how Wall Street and how trading really works because there's a lot of misinformation out there. So anyway, let's just take a look at SPY, right? We talked about how if we got to down to around 390, we would get some kind of a bounce, and sure enough, that's what happened. We got down to 392. Why did I think 390 was the level? Well, if we go back, we can see it was resistance here, and it was support here, it was support here. A lot of times, levels that are resistance turn into support because of seller's remorse. We have people who sell, and when the price moves higher, a lot of them regret selling and they tell themselves they're going to buy their shares back, but they're only going to do so if they can get them for the same price they sold them at. So we have these remorseful sellers placing their buy orders at the level that was resistance. And if there's enough of these buy orders, the level converts into support. So a big part of trading is understanding where these important levels are. Now, the S&P 500 is composed of 11 different sectors. And I think we might be running into some headwinds now that might limit some upside. And let's because three of the sectors are right up against resistance: technology, financial, and consumer discretionary. Now, if you add up their weightings, that's about half the weighting of the S&P 500. So half of the S&P 500 is at resistance. Now, here we have our technology sector. This is about 28% of the market. Notice how resistance there was resistance here. This is an example of market memory. Sometimes levels that are important can retain their importance for a long time. And we could see resistance became support, and now it became resistance again. Now, why would support become resistance? Well, this is because of buyer's remorse. People who bought, some of them regret doing so after the price goes lower, and they tell themselves, I'm going to get out, but I'm only going to do so if I can get out at break even. So I'm going to place my sell order at the same level that I bought it at. So if we have enough of these remorseful buyers placing sell orders at the level that was support, the support could convert into resistance. So it's not surprising that this is where the rally stalled out because there's resistance around this level. All right, let's take a look at our financials. Now, this is about 12% of the market. So technology and financials add up to 40%. So we can see the level that was resistance became support, and now it's resistance again. Once again, people sold. A lot of them regret doing so when the price goes higher, and they tell themselves, I'm going to buy my shares back, but only if I can get them at the same price I sold them at. So we have remorseful sellers placing buy orders at the level that was resistance. If there's enough of these buy orders, the level will convert into support, like happened here. Now, the level that was support has converted back into resistance. This is buyer's remorse. People who bought here regret doing so after the price goes lower, and they tell themselves, I'm going to sell, but I'm only going to get out if I can do so at break even, so I don't lose any money. So they place their sell orders at the same level that they had their buy orders at. If there's enough of these remorseful buyers placing sell orders at the level that was support, it will turn into resistance. And as you can see, that's what's happened here. And the last sector I want to look at today is consumer discretionary. And once again, we can see here our principle of how some price levels are more important than others. Resistance back here became support here, then it became resistance here. Resistance here became support here, and now it's resistance. So this is about 10% of the market. So these three sectors add up to 50% of the market's weighting, and they're all kind of at resistance levels. So this week will be pretty relatively easy to call, so make sure you check back. I mean, if these three resistance levels breaks, we're going to get a decent move higher. But if we don't get through them, the, then we're going to get a decent move lower. I don't think we're going to trade sideways. A lot of times, things when they get to resistance, they sell off because the investors get the sense that there are other sellers lurking around. That's why the price isn't moving any higher, and they start to get worried that they're going to miss out. So they start to reduce their prices. Like someone might say, all right, well, it's trading at 146.50. I don't want to miss out. I got to be the lowest here, the lowest price offer in town. So I'm going to go to 145. Someone else might see that and they say, all right, I'm going to go to 144. and we get this snowball effect. So a lot of times when we get to resistance and we don't get through, it's followed by a sell-off. All right. So that's what I'm going to be watching this week. Please sign up for our YouTube channel here, and please check out our website, stockmarketjobber.com. And thank you, everybody. I hope to talk to you soon.